Can you actually buy a house without a job? Like no W-2, no pay stub, nothing traditional? It sounds impossible, but it's actually not that rare. I've helped retirees, business owners, investors, even stay-at-home parents qualify and close on homes without a job in the way that most people think of it. Let me show you how it works and how you might be closer to qualifying than you think. Hey there, I'm Asher. I'm a loan officer and an educator and your guide to navigating the home buying process. In this video, we're diving into something that shocks a lot of people. You don't need a job to get a mortgage. We'll walk through how it works, who qualifies, and which programs make it possible. Well, let's talk about why no job doesn't mean no mortgage. When a lender's reviewing your application, the main question that they are trying to answer is, can this person repay the loan and can I get my money back? That's it. Now, usually they're looking for steady income from a job, but income can come in many forms. The bigger picture is the income consistent? Is it expected to continue for the next 3 years? And can you document it? So even if you don't have a boss or a paycheck, there are plenty of ways to show a lender or a bank that you're financially stable and able to handle a mortgage. Now, there are alternative income sources that do work when applying for a mortgage. Let's talk about some examples of non-traditional income that lenders do accept. So retirees, let's look at you first. You might be collecting Social Security, pension payments, or you might be withdrawing from retirement accounts. Lenders see this as stable income, especially if it's regular. You don't need a job if your money's already working for you. Trust fund recipients. If you receive regular distributions from a trust, that's usable income. Lenders want to see a history of it and as well as a schedule for what future distributions look like. You're not employed, but you're still bringing in income. Asset depletion. This one's kind of interesting. If you've got a large amount of money in savings, retirement, or investment accounts, there are programs out there that use a formula to calculate monthly income from those assets, even if you're not pulling that money out. Think of it as income on paper. Maybe you're a business owner who just recently sold their company, or you were a part of a company and now you received a big payout and you're in between ventures. You're not technically working, but you've got reserves. And in some cases, that past income history can back you up for future home purchases. Spousal income. You might be a stay-at-home parent or between jobs, but if your spouse is earning and qualifies on their own, you can be a part of that process and buy the home together. In fact, many families do this every single day. Then we have what are called non-occupant co-signers. This is when someone like a parent, a close family member, or even a close friend helps by co-signing. They're not living in the home. However, they have strong income and credit, and lenders will consider that when approving your loan. By the way, each of these scenarios are real. I've personally worked with people in these situations that I just talked about. The key to everything, though, is documentation and strategy. Now let's talk about loan programs that are specifically designed for people who don't have W-2 income. The first one, probably the most common, are bank statement loans. These are made for self-employed borrowers or gig workers. Instead of using your tax returns, you show 12 to 24 months worth of bank statements, it's going to vary from lender to lender, to prove consistent deposits. It reflects what you're actually bringing in at your job rather than what the accountant might have written off. The next loan we're going to talk about is a debt service coverage ratio loan, often referred to as a DSCR loan. These are awesome for investors. Instead of qualifying based on your personal income, the lender looks at how much income the rental property is expected to generate. If the rent that's going to be coming in covers the mortgage, that's all you need to qualify. Asset depletion loans. Like we talked about earlier, these programs let you qualify for a mortgage on the money you already have set aside. If you have $500,000, for example, in retirement or investment accounts, lenders calculate how much income that could theoretically produce even if you're not touching it at this time. And then one of the craziest products is we have true no income loans. Yeah, you heard that right. These are rare and they do come with higher down payment requirements and higher rates, but they exist. You don't document any income at all. Lenders don't even look at your work history. Instead, lenders base the loan approval on other factors like your credit score, how much down payment you're putting, as well as how many assets do you have in the bank. These are the most common with private lenders or certain investment products, and these are perfect for those who might be cash heavy but income light. Now, these are game-changing products, but the sad truth is most banks, most people out there aren't able to offer them. But because I work for the largest broker in America, I not only have access to lenders that'll do those, but dozens of other products. So remember, we gotta think about what do the banks, what do the lenders care about? And even if you don't have a job, lenders still want to minimize their risk. So here's what you need to keep in mind. With all of these products we talked about, down payment, some of these programs require 10, 20, or even more % down. Having skin in the game helps your approval chances. Your credit score. The better your credit score, the more options you'll have. Some of these programs I mentioned might require a 680, while others you have to be well into the 700s to have access to. The other thing is reserves. Lenders love to see that you have extra money saved up. If you can show 6 to 12 months of mortgage payments in a saving or an investment account, you'll stand out as a stronger borrower. But keep in mind, these non-traditional programs typically come with higher interest rates. That's the trade-off for flexibility. The key is to look at your long-term goals and possibly refinance later. So, can you buy a home without a job? The answer is yes, if you have income from the right sources, if you have assets that can be leveraged, making sure you understand what that program is that you might be applying for, and most importantly, you've got to be willing to think outside the box and work with someone who knows how to structure it. And that's where I come in. My job isn't just to find you a loan and call it a day. It's to find you the right loan for your situation. Whether you're self-employed, recently retired, or in a transition period, there might be more options than you think. You want to talk through your unique situation? Click on the link in the description to schedule a free call with me, or drop your question in the comments. I'll personally respond to all of them. If you found this video helpful, make sure you like, subscribe, so that way I can see you in the next one. See you later.